I'm delighted to be here today. We've got a fantastic panel, and I always find that it's far more interesting to have people introduce themselves. So I'm going to start off the panel by inviting each of you to introduce yourself and a little bit about your organization. I'll start off with you, Vitas, first.
Thank you. So my name is Vitas Vasiliauskas. I am governor of the Central Bank of Lithuania, and also I am a board member of the governing council of ECB. So next week we will make some decisions regarding economic situation in Europe, and I think during this session we will touch some aspects on Europe.
Frank?
Frank Holder, head of Latin America and International for Berkeley Research Group. We focus mostly on transactions and on disputes.
I'm Robert Asselin. I'm Senior Global Director at Public Policy at BlackBerry. I'm also a Senior Fellow at the Monk School here at the University of Toronto.
Brendan Greeley. I'm the U.S. Economics Editor for the Financial Times, which is a real news organization.
Thank you. Well, clearly the topic of this panel, there's many different things that we can touch upon as we look around the world and some of the geopolitical events that are happening and how those are impacting the economy and the outlook for investors and average individuals. So I thought maybe we'd start with just a more general view from some of our panelists. And Vitas, I'll start with you. As you look at the current geopolitical reality on a global basis, what are, I guess, some of your biggest concerns as you look out, and how do you think they're going to impact the economy going forward over the next few years?
First of all, I will start by saying that we are living in interesting times, and those interesting times continues from 2008. And of course, nobody knows how it will end. With all those changes in geopolitical, geoeconomic environment. I just want to say that everything depends on leaders, on decision makers, and how rational they behave. Such behavior makes impact to everybody in real economy, in policy, etc., etc. So, of course, main risk factors are related with geopolitical factors. So, trade wars, uncertainties regarding some, let's say, some countries who try to leave some clubs. All those factors, of course, make impact, and especially they can make impact to the not only to the global environment as such, but also to the Europe, because Europe is a big open economy. It depends on global trade, and when you have some changes in the trade system globally, then of course you think what can happen. Central banks, they are doing big things. They are buying a lot. As I say, they are buying everything what is moving. And we need support from other policies too, because one central bank as such cannot solve every or all let's say problems. So if you would ask me what is your forecast for the nearest future, my answer would be, who knows? Depends on human behavior or some humans' behavior.
Yeah, difficult time. So no predictions for us today on the Brexit situation.
Yesterday I was thinking that we can expect to have no deal Brexit. Now, after last voting at UK Parliament, who knows? I think we can expect new elections, and then we will see what be the outcome of that election and elections, and Of course, as it was said in the first session of today, no deal situation is a worse situation for everybody, especially in Europe.
Yeah, it's interesting. From my perspective, I spent a lot of time in different financial centers around the world, and as much as we sometimes compete, in particular European financial centers are competing, I think most people agree that having a strong financial center in London is a good thing. So it's difficult times in all sectors, but certainly the financial sector is one for sure that will be negatively impacted and has been. Maybe we'll turn over to you, Brendan, to talk a little bit about the China-US situation, the trade tensions there, and how you see things. I guess what are the different scenarios you could see playing out there, and the impact on both the US economy and the Chinese economy, of course, as well.
So I think we went through a long period where markets shrugged off political risk. And when you saw increased tension between the United States and North Korea, for example, the markets didn't react. Nobody seemed to perceive that the actual rhetoric indicated risk. That time seems to be over. And one of the things that I hear from both the CEOs and from people at the Fed is that there's a distinction to be made. We talked a little bit about it this morning in the session between trade negotiation and trade uncertainty. So in a negotiation, there's a deal, you'll get there. You as a business person might not like the terms of the deal, but there will be certainty, it will be signed, you will move on, you will sell products. What's happening now is uncertainty. Nobody knows what's going to happen. And particularly after a deal was inked between USMCA, the changes to NAFTA, the fact that after that the president was willing to consider tariffs on Mexico was unsettling to a lot of US CEOs. They realized that it's possible that it may never be settled, that there will always be trade negotiations. So uncertainty is hard to quantify. We can't really measure it. But if you look at indexes that measure economic surprises, right, there's a distinction between the last year and the previous 10 or 15 years. And there have been a lot of surprises over that period. So what does that mean for what's actually happening now? It means that today the Fed's Beige Book came out. That's just a look at basically anecdotes, structured conversations that all the Fed banks have with CEOs. And one consistent thing that came out is that even though consumers are spending and manufacturing results were mixed, manufacturers are reluctant to make large capital decisions. So political risk suddenly has become economic risk, and we're actually seeing it in the data.
Yeah, markets, well, they like to think they're pretty good at pricing risk, but uncertainty, not so much, and business leaders are the same. So Frank, maybe I'll invite you to comment as well, because I know you spend quite a bit of time as well in Asia with your business, and probably have some perspectives on how it could play out both in the Asian market and from the US perspective as well.
So it's interesting to hear what Vitas had to say about leaders acting rationally and that being an important factor in economic growth and certainty. I'm a little bit terrified if that's the case, because we've seen not the highest degree of rationality in some of the key economic relationships that are going on. I think, if you think about it in a sort of in a macro political sense, there's really a crisis of inequality and a lack of inclusion in the world economy by giant portions of the population. And this even includes some of the richer countries by GDP growth. And it's created an environment where there's somewhat a crisis. I would call it a crisis of capitalism, but there's sort of no other model to offer out there. So it's really a crisis just in general, a political crisis. And when you look at what's going on in the world, you certainly see multilateralism on the decline. And this, to me, is irrational. It's irrational because you can measure how positive that has been for the world in general, and for many, many countries. And yet, you see more and more multilateral organizations having key members quit or be less active or less involved. You see more and more bilateral issues occurring. You see more and more sanctions occurring. And so, you know, when you look at the relationship between, in particular, China and the United States, you're really looking at a technological Cold War at this stage. The U.S. is doing everything, or at least this administration, everything in their power to stop the advance of certain Chinese technologies throughout the rest of the world. There are punitive measures being taken, but there are also measures that have an indirect but maybe even greater impact in terms of research and development and the future of the economy. So whether it be artificial intelligence or 5G telecommunications networks or, you know, other areas, these areas of contention, it's incredibly unusual to see this occurring, and it's affecting the rest of the world. So an example of that is projections for GDP growth in Latin America for 2019 were back as late as last year were 2.5% as a region. The latest projection is 0.9%. That's a very profound difference, and it affects millions and millions of people. Most of it is related to a slowdown in China, which means the purchase of less commodities out of Latin America, which leads to lowering of commodity prices, which leads to economic crisis and also political crisis. So we seem to be ping-ponging between left and right sort of administrations around the region. And I do have to say that having spent a lot of years in the emerging world, political risk and economic risk were the same thing. There was no difference between political and macroeconomic risk. That's something new to the US, something new to Europe, at least in recent Europe. It's something new to some parts of Asia that don't even function as democracies. But I absolutely agree with your point that political risk is now the most difficult thing to measure and maybe the biggest impact on macroeconomic goals and objectives that governments have.
Maybe, Robert, you'd like to jump in on that particular theme, too.
Yeah, I mean, the challenge being fifth on a panel, it's coming up with something that hasn't been said. Obviously, I agree with my colleagues generally. A few points I would add. First is on the absence or the lack of norms. I think this is very problematic. You know, in the international architecture after the World War II, we designed institutions to resolve differences. WTO, the Bretton Woods instruments, IMF, the World Bank, all these institutions now have lost a great deal of legitimacy. So that's the first point, very problematic, especially when you know, the US as the world leader on designing these institutions don't really believe or don't seem to believe in them, at least through the president now. The second point is on the risk of a slowdown. I think, you know, if you look at the economic indicators, you have a lot of people, even from the Fed, saying, you know, the US is still doing well, the economy is at full capacity almost, labor market's doing okay, but all this uncertainty, people are sitting on cash, not investing in the economy, and that's the problem, and it becomes a self-fulfilling prophecy where there's a lack of trust in the economy, and then people don't spend, and consumer become nervous, and etc. I think the problem we'll have, just to take the conversation a bit further, is that when the next it comes, monetary policy and fiscal policy won't be as useful as they were in the last recession, global financial crisis. And I think that has to worry some people. Interest rates are already very low, so there's so much that central banks can do. And fiscal policy in most countries have been used extensively so that government don't have much leverage as they used to. So I think that's something we have to be worried on the business side as well.
So sitting in your seat, you know, wearing your BlackBerry hat, you know, how is that impacting your business as you see it on a day-to-day basis?
Yeah, I mean, going back to Frank's point, the US-China tech war is really what is problematic, is that you don't see a short end game there. Even if there were to be a political deal, let's say, to calm the markets, and Trump would come to reason and say, I'm going to make a symbolic deal. We know structurally there's an issue there that'll go on for some time, where you actually try to deconstruct supply chains that have been built over time. You know, in an iPhone, there are a lot of items that come from different parts of the world, China being one, and now you're asking Apple to basically design an iPhone with no Chinese components. That's a very different ballgame. And I think that's what we're dealing with. So for a lot of companies, now they're realizing that this is not something temporary, but something that is more structural. And it's an all new ballgame with no, as I said, no international architecture to deal with this issue.
Any thoughts, maybe Brendan, you want to comment as well, or Robert, on are there any winners there as these supply chains start to change, in the case of BlackBerry or just generally?
I can tell you that in today's beige book, which I happen to have read very carefully, there was actually one electronics manufacturer that was re-onshoring, looking at tariffs and thinking, all right, well, we got no choice. This is the way things are looking. We're going to build out production capacity in the U.S. That was the first example that I'd seen of, this mythical beast that economists talk about, import substitution, right? So that's actually, it could be that will happen in the U.S. I think more broadly when we talk about the collapse of institutions and the disruption of supply chains, these are things that have, obvious consequences for economic growth, both in the United States and in the rest of the world. I think that there's a desire when we talk about this that we can go back to the way it was before. If anything, the political changes that have happened in the United States are an indicator that the way it was before was not working. And I think that's something that's gotten lost. Economists didn't really have a good way of looking at how trade affected communities until very recently. They didn't have the data, they didn't have the tools, they didn't have the models. They do now. And what was in the early 2000s a lot of hand waving? Yeah, well, some people will lose their jobs, but it'll all work out. We now know who lost their jobs, and we know how those communities were devastated, and we know what happened when opioids entered those communities. We have a much better statistical understanding of these things that real people in the real economy were worried about and angry about, that policymakers and journalists and economists were not paying attention to. So I don't think it will be possible to go back to the old institutions. I think the new institutions will be different. And I want good multilateral institutions, and I think that we can agree that they're good for economic growth. But if that growth isn't willing to be shared with all the communities that are being affected, then the new institutions won't work any better than the old ones did.
Vitas, would you like to comment on that too?
Yeah, so I can agree that we can't go back or have the same institutions as it was 2, 3, 5 years ago. Of course, we need some changes. Just facing reality. Those steps from some reacting to the steps from some countries' initiatives. What regards your question on winners and losers, so I don't think that we will have any winner. I always remember the statement, that the worst peace is much better than the best war. So what is happening now makes me not so very optimistic. What regards, for example, China and U.S. Those negotiations or how you call it in other words, a half year ago I was more optimistic than I am now. And even if we will have a solution, even if we will have an agreement, we cannot be sure that after some months it can be changed, it can be, interrupted by one side. So, and this unpredictability is a very important factor which makes impact to daily solutions. Before becoming a governor of central bank and in 2011, I never thought that in my profession I will have to pay so much attention to geopolitical factors. And it is a new reality for the moment. And it scares a little bit me.
Maybe, Frank, we can turn it over to you to talk a bit about the Latin American perspective that you've gotten from your business and some of the issues you're seeing there. You talked briefly about some of the impact of China earlier, but just more broadly, some of the events that are impacting the economies there most dramatically.
Sure. Well, first thing I would comment on is the technology sector is an ecosystem, and it's an ecosystem that is global, and the problem with nationalistic policies or bilateral policies is that the effect it has goes far beyond any of the predictions that people could make as to what's going to happen. So certainly these types of sort of using an old methodology, let's say, to solve a modern problem is really clearly not working. And it's funny to hear the word import substitution. I thought we killed that off in the 1970s. So the fact that people are even talking about that today is unbelievable. Any economist will tell you you study that as part of your economic history class, not as part of current reality. But unfortunately, that's what people are trying to do or what they're left with. And so, you know, the one thing I would say is from a Latin American perspective is none of this is terribly surprising because many of these things have been tried in the region and have failed in the past. And so one of the real challenges we're having that nobody has mentioned yet in the panel, but we're all talking about indirectly, is the rise of populism. And in Latin America, that's been a real challenge. So when you get a populist government in, they will follow a set of policies that are incredibly destructive long term, but will it secure them votes, control, et cetera, for a period of time? Probably the worst example of failed populism would be Venezuela, where we have a huge humanitarian crisis that seems to go on and on and on. But there are others. There are other examples. Argentina is about to flip back into one of those regimes in October. I think more reasonable than the one that came before, but it's got a lot of people worried and created some issues. And so, you know, when you look at the way it's affecting business, if China's GDP shrinks by 1 percentage point, Brazil's shrinks by 2. That's literally how closely tied those two economies are to each other in terms of the export of major soft and hard commodities from Brazil towards China. You know, if you look at the automotive sector, Mexico is incredibly tied into the US, Canadian, and foreign automotive sector, and it's very complicated right now what's happening. If a tariff goes here, where do you bring, you know, a product in there? And the new rules that say X amount has to be made in Canada and the US versus Mexico, it's going to be very complicated and not be helpful for that economy either, and these are the two biggest economies in the region. So there is a degree of pessimism around that, and there's a huge frustration with the power the U.S. has today based on the U.S. dollar. So the other thing that nobody has talked about yet explicitly, but is a very big deal, is that there was a belief up until not that long ago that there would at least be 1 or 2 competing currencies in the world to the U.S. dollar. There isn't. The euro is no longer is solid enough to do that, to fulfill that role. The yuan is being utilized for other purposes. And so you're left with the Swiss franc, which is teeny tiny and hugely overvalued, and the dollar. And so, you know, we heard a conversation last night about cryptocurrencies. This is, I think, the Canadian president of the Central Bank of England, the Bank of England, Carney, who said the central banks should all get together and create their own cryptocurrency as a counterweight to the dollar. Gold's at $1,500 an ounce. That tells you just how desperate people are to have safe haven besides the dollar. So that gives a tremendous amount of power to the United States, and it's probably not for the best at this time.
So, given all of that we've talked about, as you view the current economic cycle and where we're at, maybe Vitas, I'll ask you to start. Where do you think we're at this point in terms of the economic cycle and the outlook for the next year to 2 years?
You know, it's a question of price of $1 million, you know. So, and globally, of course, we are in, let's say, in a situation with a balance of risk is downside. Just look to World Economic Outlook made by the same, for example, IMF. So I think we can expect in the middle of October that it will be decreased the second time this year. But of course, different countries are doing differently. But those countries who are doing, or those countries where statistics says that situation is not so bad, my personal view is that it is only a temporary factor, because downturn in global economic will touch every country. So just look to Europe. The biggest economy, Germany, probably will face technical recession. But of course, I don't want to speculate. Next week we will have a newest data on Europe, and we will see. So to sum up, I am a pragmatic and realistic person, and I see a lot of clouds.
Any different views? I'll pass it over to you, Frank, on that front.
No, I'm clearly the pessimist in the group, so I think it will be revised downwards. I do believe Germany is in a technical recession at this stage. I think that it's very unusual to read that France is growing more quickly than Germany. That hasn't happened in a while. Latin America has been revised downward twice. The U.S. is doing relatively well. The problem in the U.S. is somewhat sort of the distribution of that growth. There are still large parts of the country that have been left out of the GDP growth and the employment growth that we've seen. There's a lot of uncertainty around Brexit, continues to be. It's almost, it's just riveting to watch that unfold, and not in a good way. And we have to see, you know, on the Asian front, a lot depends on how China weathers this small dispute with the U.S.
Maybe I'll switch the question a bit, Brendan, if you, or go ahead.
Well, I would resist the idea that we should think of what's going on right now as part of a cycle. It doesn't seem like what's going on, the shifts that we're seeing in this year, are part of a sort of standard business expansion or contraction. I'm also actually pretty pessimistic. And we can talk about how the old relationships weren't working. But the way you change them is by renegotiating new relationships. And that's not what we've seen. What we've seen is an erosion of trust. And you can't have any sort of relationship whatsoever. And I think that if policymakers are arbitrary, then it's very hard to see what that new trading relationship is going to be. So the consequences of that are not that we're going to see a contraction. It's that we're actually looking at a shift into a completely new way of running our global economy. And when we talk about Germany being in technical recession or close to technical recession, however we want to call it, that's just because Germany is the most export-oriented major economy. The exact same thing is happening in the U.S. as is happening in Germany. It's just that in the U.S. we have the luxury of having manufacturing only be 11% of our GDP. And we're just not nearly as reliant on exports. But the same disease is happening. We just happen to have a better consumer immune system. So I don't know that we're sort of on our way through a cycle. I think that we're sort of walking through a door is maybe a better metaphor. And I don't know what's on the other side.
So in your view, if all of a sudden there's different leadership, let's say in the US or Brexit somehow manages to work itself out in a positive manner, your view holds, you think? It's just a different time?
I mean, I don't know. I can't see that scenario, right? I don't see the outcome for the U.S.-China relationship. I don't see, because so much trust has been destroyed, the ability to negotiate has been destroyed. It doesn't look like we're going to get anything before the next election. I'm not a Brexit expert. There are about 50 people at the Financial Times who understand Brexit better than I do. But it does seem there that once you start to negotiate in the way that they've been negotiating, so much trust has been eroded, I don't know what that new relationship looks like. I don't know that you could slot the UK right back into Europe as if nothing happened if there were a parliamentary vote doing that tomorrow. So I mean, no is the answer, is the short version.
Robert looked like you had a comment there.
The only thing I'll add is on the macro side, when you look at the economy, inflation has stayed pretty low, and central banks have kept the rates at minimum level. And that's what has to be worrisome, I think, when you look at the future, because if business investment doesn't pick up in those circumstances, you can figure out that they will not, in better circumstances, in worse circumstances, that things will only get worse. And so I think that's the sign, and Larry Summers has written a great deal on this, even like the ineffectiveness of central banks to deal with this issue, because monetary policy has been used to the extent to which it could. And now we're faced with very little levers. There was a former central banker who now heads research, Canadian actually, Jean Boivin, who's at BlackRock, who wrote a great piece, I think is the FT, on central banks creating liquidity facility directly to citizens. I thought it was pretty interesting conceptually that someone would come to this, but it tells you how little options there are on the table when that downturn will come.
So in this current environment, what advice do you give to companies, I guess, at this point who are, making investment decisions, given that environment? I guess from BlackBerry's perspective, you feel it every day, right?
We do, and the thing is, in a tech company, what you have long business cycle where you need to invest in the future, and the way you do this is investing in R&D to develop new products and new software. And this is what the new intangible economy is all about, which is the value now in the markets, when you look at the S&P 500, is really much into intangible assets, IP, data, brand, and that's where you need to invest. But if you don't, because you're so worried about the environment and the economy and geopolitics and trade tensions, then you're stuck on neutral. So we're moving forward, obviously, and we're very confident of our cybersecurity software niche, but it's a very challenging global environment, there's no question.
Yeah, definitely. As we look forward and we think about the average investor, as a financial sector, what should we be telling them in the financial sector in this current environment with their own investments? I know people have different views on that, but maybe Vitas, in your position?
My suggestion would be, just to sleep with open eyes, So, and what regards, for example, financing possibilities in Europe, it is no problem. So financing is very cheap now, and I think it's good time, to just take loans, but of course, the main risk is related with uncertainty in the future. And sentiment indicators in most areas of business, of consumption in Europe says that future is not so very clear. Consumption for the moment is okay, but what regards business sentiment, we are facing the let's say, lowest level since 2017, 2018. So, and the trend is not so very good.
Any words of wisdom from other on the panel?
I'll just note that there's 14 trillion in negative yielding bonds right now in the economy. That's a bit scary. So people are willing to lose a little bit compared to lose a lot. I think that's a big signal. So there's no safe haven right now, I don't think.
I'd say it's one of the best times to invest, actually, because so many people are being cautious and are putting good investments on hold. And there's a lot of need for liquidity in projects that are good projects, but can't secure it because of a lot of this political uncertainty. but you need to be very selective in the investment you're going to make. And maybe for the average investor, that's extremely difficult. For a corporate investor, it should be much simpler. And the other thing is factor in political risk into your investments, because I have so many clients, so many corporate clients that don't look at their return on investment taking into account macro-political risk. So they look at economic factors, but you don't see any of the other factors in there. If the return on your investment is high enough to take into account the political risk you're running, it probably makes sense to invest. And if it's not, no matter what the cycle is, it doesn't make sense to invest.
I don't have any advice on sort of portfolio allocation. My wife and I have retirement plans and somebody else allocates it for us. I can say that there's a problem with the way the profession of economics talks about the word savings. So anything that anybody's saved has been seen as savings. And there's been sort of almost a moral way of talking about it in economics textbooks, right? There's a savings function and a consumption function, and it's always good to encourage people to save. So there are two assumptions that are implicit in that. One of them is that average saving is the same as median saving. That if we encourage saving by a few people, that we'll encourage saving by everybody. That's not true. In the United States and all over the world, we have tremendous average saving, a glut of savings, and it's one of these things that's driving returns on investments down. There's so much money chasing so few viable investments. But we have terrible, at least in the United States, terrible median savings. 50% of Americans don't have access to a retirement account. Those who do, the median amount in the retirement account at retirement is $60,000. That's not enough to retire on. And so we have these policies that encourage savings, when what we really need is to think about, how do you retire? How do you make sure you're taken care of in your old age? And that's a completely different set of policy questions. And so for too long, we have said, savings is good, it's better than consumption, we need to encourage it. Whatever savings we can encourage are good, and we've left it at that. So the one policy lever that always works in America, that you can always get through Congress, that you can always get a president to sign, is lowering the cost of capital, encouraging savings. That's not working anymore, because we have all these negative yielding bonds, we have too much capital. Strange things for journalists at the Financial Times to say, but it's true. And so I think we need to think about savings and retirement and investment in a different way, and it starts with making this distinction between average and median. Average is great, median is rotten right now.
Yeah, and I think it goes back to some of our earlier discussion around this financial inclusion piece, right, and making sure we're not leaving people behind in a multitude of ways if we want some of this uncertainty and current sentiment to go away. I am cognizant of time, and I did want to leave a little bit of time for at least a couple of questions from the audience, so I will turn it to the floor now. Are there any questions for our panelists? I know we're at the end of the day and in between you and cocktails, so we understand that, but wanted to leave at least a moment. Yes, at the front. Do you have a mic there? Oh. Is there a mic?
Question for
sure.
the panel. You touched on it, Jennifer, briefly, but about 3 weeks ago, Matt Desmond in his article in the New York Times.
No one can hear you.
Thanks, Frank.
Jennifer, you just touched on it now, but about 3 weeks ago, Matt Desmond in an article in the New York Times was talking about the wealth and lack thereof in the United States. In theory, the wealthiest nation on earth. And he mentioned that a larger share of working age people, 18 to 65 years old, in the United States live in poverty than in any other nation in the OECD, as a statistic. I didn't verify it, I'm assuming he did. And that seems to be at the root, and it's different obviously in other countries, but I think the essence of it is there, which you're talking about people being left behind. And that's not as much about a trade issue, and it's not so much about who's in power and who wins the next election and whether the UK leaves the Eurozone or not. It's a much more fundamental way of how do we structure our society, and all of this seems to be pushing us into, we're either going to be in a bad place, as you suggest, as we walk through the door, or we're going to fix it. And I was wondering if anybody had any ideas about how we might fix it. Thank you.
It's an important point. Any comments on that?
I'll let the Americans speak.
God. How to fix it? I wish I had more encouraging words. I wish it were the role of the press to do something slightly different than what we do. We're here to poke holes in arguments, and it's harder for us to think conceptually about, here's a thing that you should do. I do think that in America, we have given up the idea that we can make fiscal policy. And one thing that I hear all the time from Fed presidents on and off the record is, well, they all say it on, so I don't even have to do that. We need more, better, targeted fiscal policy. We need to act like a country that is capable of taking in taxes and spending on programs in ways that make things structurally work for the country. And so I think that it seems from the outside like that's true of Europe as well. It's 100% true of America. And we think about the ways we've been making fiscal policy. We got a fiscal expansion this year because we released the sequester caps, right? So it's inside baseball, but in America, for weird, ridiculous political reasons, we had constrained federal spending for a long time, and then we finally got together and said, okay, we're going to stop constraining federal spending in a stupid way. We got this beautiful stimulus. That's a really dumb way to do it. So I would like to see better, I would like to see hope in America that we are capable of taking in revenue and spending on programs in a way that we can rationally agree on as an economy. And what we do instead is look to the monetary authorities, because ironically, the least democratic institution in America is the most responsive, the most thoughtful about what's happening. And I thought it was interesting today that Christine Lagarde, speaking to the European Parliament, floated the possibility that if European governments could get together and structure green bonds to do a transition to a green economy, that the ECB would consider buying them. I thought that was amazing. I mean, why is that her problem and her solution when governments themselves can get together and do that?
I was just going to say, she also said she wasn't the fairy godmother, right? So, look, the elephant in the room, not speaking politically, is education. So the U.S. has got a real problem where we have these phenomenally good universities that produce enormous amounts of intellectual property, and then we have the flip side where we don't do very well with primary and secondary education, also on the vocational side. So there are entire swaths of the country that have been left out of the new economy. So when I was talking about inclusion earlier, that's what I'm referring to. And the flip side to that is also productivity. We've been getting gains through technology that hasn't really transferred into, when you're looking at mean and median, we're much more productive in some ways, but the population as a whole is not. Productivity is lagging behind technological advance. So I think those two factors, were someone to take them seriously besides a central banker, it might really help.
I can only agree with what Brendan said, you know. So I think central banks alone can't solve the problems. So, and that was the reason why I think we at European Central Bank 3 or 4 months ago in our concluding statements introduced some sentences regarding need of action for governments. And first of all, of course, we had in mind fiscal policy. Without that, without very specific fiscal policy, of course, those fiscal policies are different in different countries, but all countries knew best what they have to do, you know. Without help of such steps, you know, the Europe can't find solutions. And the other issue, I am big fan of, let's say, federalistic approach in the Europe. Without that, without common bond, without completement of the banking union, we can't find good solutions. So, but regarding Europe, I am quite optimistic because every crisis helps us to find new solutions. And I'm more than sure if we will face this time the same thing as it was in 2008, I think we are better prepared that we were then. But the question is, will it be the same?
So I think we have time for one more question. There's one at the back there.
I
We can
have
get
a
a mic.
question to Mr. Vitas. Part of this question is to finalize his thought. As a member of ECD, through your work, do you actually see the impact of your ideas, and I believe ideas in representing Lithuania also, in the way the bigger players such as Germany and France are acting in European community?
You know, ECV Governing Council is working in such a model that we try to reach a consensus. Of course, we have a voting formula, but as far as I remember, we never had voting on monetary policy issues. Of course, I am the, let's say, newest member of the Governing Council because Lithuania introduced euro in 2015. But during those four years, I never remember that we voted. So we try to discuss issues, you know, and we try to think pro-European. I mean, we leave our national mandates at home because we have to think about whole Europe. So, and I hope it works. And that is the reason why multinational mechanisms are very, very important. Because national solutions are very dangerous in that sense that it can become very popular. And this thing will end EU as such.
Thank you. I'm cognizant of time. Thank you very much to the panel. It's been a great discussion. I think obviously serious issues and perhaps not all good news on this panel. I think certainly my takeaway is as we think about the future, we do need to assess risk in a very different way, and geopolitical risk is one that I think as business owners, as investors, we're all going to have to understand in a much different way going forward. So thank you very much for your perspectives, very valuable, and thank you very much to the audience.